Here is what nobody in crypto wants to admit right now. The market is not going up together anymore. It is not going down either. It is splitting. And depending on which side of that split you are on right now, either you are watching your portfolio grind sideways while the world moves on, or you are watching serious institutional money quietly positioning itself for the next phase. Bitcoin is in what analysts are calling a hibernation phase. Miners are getting crushed by economics that do not work even if Bitcoin climbs another 30%. ETF firms are cutting staff, and meanwhile AI infrastructure companies are surging. Regulators are writing rules without waiting for Congress, and stablecoins are being tested by central banks in cross-border settlements. This is not a normal market update. This is a story about who survives this squeeze. What is going on, everybody? Welcome back to Crypto Cobra. If you are new here, we break down what is actually happening in crypto markets, cut through the noise, and give you the context you need to make informed decisions, not emotional ones. Today we are doing something a little different. Instead of just running through headlines, we are going to connect the dots across everything happening right now and show you the single clearest picture of where the market actually stands. We are covering Bitcoin market structure, mining economics, and the regulatory push that is happening right now. Whether Congress is ready or not, how AI infrastructure is pulling capital away from crypto, what is happening with ETFs and the institutional level, and the altcoin and exchange drama that is still very much alive. This is a lot of ground, but by the end of this video you are going to have a coherent framework for understanding everything that feels confusing or contradictory about the market right now. Let's get into it. Let's start with the overall market mood, because this is the foundation for everything else we are going to talk about today. Bitcoin is trading in the low $60,000 range. Now on the surface, that number does not sound alarming. $60,000 for one Bitcoin is not a disaster, but look underneath the price. The picture gets more interesting. Perpetual futures trading activity, which is one of the best real-time indicators of trading enthusiasm and leverage appetite, has hit a multi-year low. Think about what that actually means. Traders are not putting big leverage bet on Bitcoin right now. The people who normally juice volatility on both sides are sitting on their hands. The market is waiting for what? Macro data, specifically CPI numbers, inflation readings, the kind of information that tells the Federal Reserve whether hold rate, cut rate, or single anything at all about liquidity conditions. Crypto has become more macro correlated than its early believers ever wanted it to be. When the Fed is uncertain, crypto traders are uncertain. When inflation data comes in hot or cold, Bitcoin moves with it. So the first thing to understand is that we are in a low volatility holding pattern driven by cautious leverage, macro uncertainty, and a market that has not yet found its next clear catalyst. This affects everything else we are going to talk about today, because when Bitcoin is flat, the business built around Bitcoin start to feel pain, and that pain is very visible right now. Let's talk about specifically about Bitcoin and the business built around it, because the headline "Bitcoin is flat" understates what is actually happening at the infrastructure level. The hibernation signal. Analysts are using the word hibernation to describe Bitcoin's current market phase. Low volatility, low leverage, low conviction. The market is not bearish enough to panic and not bullish enough to chase. This kind of phase can last weeks or months, and historically it tends to resolve with a sharp move in one direction once a catalyst arrives. The problem is that every day hibernation is a day where the businesses that depend on Bitcoin activity, miners, trading platforms, derivatives desks, are operating in a low revenue environment. Miners are feeling it directly. On-chain fee revenue for Bitcoin miners has dropped to levels that are genuinely difficult to sustain for many operations. Here is the core economics problems. Bitcoin miners earn revenue two ways. Block rewards, which are the new Bitcoin issued with each block, and transaction fees, which are paid by users to get their transactions processed. After the halving, block rewards were cut in half. That was expected and priced in by most serious mining operations, but transaction fees have not made up the difference. Network activity is low, fee revenue is low, and many miners are watching their margins compress in real time. The renewable mining trap. Here is where it gets really interesting. There are mining operations running on renewable energy, which sounds like a sustainable, forward-thinking model, and in theory it is. But the math is brutal right now. Some analysts have modeled out that even if Bitcoin appreciates 30% annual from current levels, certain renewable mining models are still profitable. Let that land in for a sec. 30% annual appreciation on Bitcoin, which would be a strong year by most historical standards, is not enough to make some mining operations cash flow positive. That tells you how much the halving combined with low fee revenue has changed the economics of this business. The Treasury model has a workaround. Now contrast that with something like 21's approach. 21 is building a massive Bitcoin treasury. We are talking about a significant holding position, and they are structuring their business around Bitcoin as an asset rather than Bitcoin as something to mine or trade. But here is the catch that the market needs to understand. The valuation of a company that holds Bitcoin in its treasury is not the same as just owning Bitcoin directly. You are paying a premium for its structure, the management, the public market access, the capital raise capability, and that premium may or may not be justified depending on what you think about the company does with that treasury over time. This is the new game in Bitcoin, finding ways to package exposure into business structure that can raise capital, attract institutional investments, and generate returns beyond just holding the asset. It is creative, it is interesting, and it is a sign that the easy money phase of just buying Bitcoin and waiting is being replaced by something more complex. The core question of this section is this: is Bitcoin still the asset everyone wants, or is it becoming harder to profit from the ecosystem built around it? Right now, the honest answer is both things are true and at the same exact time. This is the section I want you to pay the most attention to, because this is where the long-term structure of the crypto market is actually being decided right now, not in some future congressional hearing right now. The SEC and CFTC are writing the rules. Here is the situation. Congress has not passed comprehensive crypto legislation in the United States. The regulatory framework is still fragmented, contested, and nuclear. But the SEC and CFTC are not sitting around waiting. Both agencies are actively writing and enforcing rules around crypto, and doing so in ways that may not survive mental legal challenges, are shaping the market behavior in short term and medium term regardless. This matters because regulatory uncertainty is one of the biggest reasons institutional capital has been cautious about deeper crypto exposure. If the rules keep changing, or if we get written agencies and then challenges in court, businesses cannot plan, they cannot build compliance infrastructure, they cannot make long-term bets. Perfect example of this is what happened with Kalshi. Kalshi is a prediction market platform. They ran into a legal challenge in New York, specifically around their trading products. The CFTC stepped in with an emergency powers to keep Kalshi operational while that legal challenge plays out. Think about that for a moment. An emergency regulatory powers being used to keep a crypto prediction market running while it fights a state-level lawsuit. This is not normal. This is regulatory improvisation in real time, and it signals that regulators themselves are still figuring out their own boundaries while they try to manage the market. Across the Atlantic, the picture looks different, but equally significant. The Bank of England is actively testing stablecoins and digital currency infrastructure for cross-border finance. This is a central bank, one of the most conservative and historically cautious financial institutions in the world, running live tests of stablecoin technology for settling real transactions. That is not crypto enthusiasts' experiments. That is monetary infrastructure exploration. And to add to that standard, chartered backing anchor points rollout of HKDAP stablecoin infrastructure in Hong Kong. Hong Kong has been positioning itself as a regulated, institution-friendly crypto hub. And now you have a major global bank backing stablecoin rails in that jurisdiction. And we need to take a little break here to just take a sip of some Monster after my 1.5 month vacation. And now you have a major global bank backing stablecoins rails in that jurisdiction. This is what institutional stablecoin adoption actually looks like. Not a tweet from a crypto influencer. A major bank with compliance infrastructure backing payment rails built on stablecoin technology. Russia restricts retail, open doors for qualified investors. Russia has taken a different approach, restricting retail access to crypto trading while creating more structured access for qualified institutional investors. This is a pattern worth nothing because it is showing up in multiple jurisdictions. The direction globally is restrict the retail speculative angle, build institutional on-ramps, bring crypto under regulatory frameworks that mirror traditional finance. Crypto is becoming more institutional, more regulated, and more fragmented, and all at the same time. If you are building or investing in crypto right now, the regulatory environment is not a background story, it is the main story. The question is not regulation is coming, it is already here. The question is which regulatory regime are going to create the most workable environment for innovation, and how quickly the global patchwork gets resolved into something businesses can actually plan around. Okay, now we got to what I think is one of the most underappreciated dynamics in the current market. Capital is rotating, and it is rotating in a very specific direction, away from crypto infrastructure and towards AI infrastructure. CoreWeave is a cloud computing company that specializes in GPU infrastructure, essentially the hardware backbone that powers large-scale AI training and models. CoreWeave has been surging on the back of AI infrastructure demand. Hyperscalers, the big cloud platforms, are in arms race to build out compute capacity for AI models. And the demand for that compute is creating a gold rush in the infrastructure layer. Now here is where crypto comes in. Some of the main energy infrastructure and hardware infrastructure that Bitcoin miners use is now being competed by AI hyperscalers. And the AI companies can pay more because AI inference and training generates different economics than Bitcoin mining. Revenue models are different, the margin at scale are different, and right now the public market valuations are very different. What you are seeing is Bitcoin miners in certain markets getting out-competed for energy access and hardware access by AI infrastructure players who are willing to pay a premium. This is a capital rotation in its most literal form. Money is chasing the infrastructure that powers AI right now, while crypto infrastructure is being forced to re-justify its economics. And as you all see, AI agents are booming right now. Yesterday, I actually created something called Vibe Voice, a GitHub free AI that can actually talk. You can give it a script and it can read out a script and it sounds very real. Okay, and it's quite dangerous. I want to be careful here not to overstate this as AI is killing crypto, because that is not what is happening. What is happening is a repricing of which infrastructure bets market finds most compelling in 2026. Crypto had its infrastructure gold rush, GPUs for mining, custom ASICs, energy contracts, data centers. AI is having its infrastructure gold rush right now, and some of the capital that might have gone into crypto infrastructure is instead flowing towards AI compute. So this was all for today's video on crypto. I just wanted to give you something 100% for free because you actually watched the video to the very end here. I created something very special. It's a Telegram group. You can actually join and you can ask it different questions about what's the latest news on crypto, what's the market pair and greed index, a lot of freaking things you can do on that app. I'll have it in the description of this video, and I hope you all have a great day. It's been a great month. I was off around 1.5 months, didn't create a single video. Now I'm back because now it started again. Bitcoin is actually, I think, the most talked about thing actually, because Bitcoin is up. You have other meme coins and other coins below, but Bitcoin isn't going anywhere soon. So make sure you subscribe, like this video, and share this video with all of your wonderful friends. Have a great day. Take care.